Good afternoon, everybody. Welcome to the weekly wrap-up here at the Liberty Call. It is Friday, January 20th, 2023. I hope everybody has been having a fantastical week out there. Got my driveway cleared. Didn't have a heart attack out there. Did tweak my back right in front of or behind the left sciatic or the SI joint. Woo! It's a spot my whole life. I mean, even going back to two-a-days as a football player in high school, it's a spot I've tweaked multiple times throughout my life, and it kicks your butt. I think it's more of a stabilization muscle, and I mean, it hurts to walk, it hurts to stand up. Pretty much the only time it feels good is like laying flat with a heating pad on it. So it's much better today, but yesterday, I think it was just, trying to steer that big old beast of a snowblower. I must have twisted wrong or something, but it's still barking a little bit today. Anyways, like I said, hope everybody's having a fantastic week. It is snowing again here in Colorado. So hopefully not too much, because I really don't feel like going and clearing more snow. And the wife is on her way back from the airport in Denver. And we live about halfway between Denver and Colorado Springs. So it's not a short drive. It's about an hour and a half, depending upon traffic and weather. So hopefully she drives careful. I'm expecting her to call here in a second. Her plane just pulled up to the gate about 20 minutes ago. So anyways, if it's your first time watching, please give me some thumbs up, likes, shares, subscribes, follows, all that good stuff, whatever platform you're watching this on. I would greatly appreciate it. Maybe drop me a comment, say, hey, Ray, could you talk about this next week? Or could you expand on that? I certainly don't mind. I always love suggestions or topics to talk about. It looks like the week is going to finish off in the green here, at least domestically, and across the globe, I see a lot of greens too. So for the week, I think we're going to finish up in the red for the weekly numbers, but again, not really surprising with all the things that are going on. Got a bunch of economic data to go through. Doesn't look real great, but it is what it is. Today's market recap, and then why the Fed is insolvent. So not good news there long-term for the Federal Reserve. So, all right, well, let's go ahead and let me make this a little bigger so you can see it. And let's go ahead and jump into the numbers. Right, Dow Jones finished the day up 1%, closed at 33,375. It was up over 330 points. The S&P 500 was up 1.89%, closed at 3972. NASDAQ was up 2.66%, closed at 11,140. Small caps are up 1.55. The VIX fell today, 3.27%. It's back below that 20 threshold that I view as a caution light. It's currently at 1985. So again, not too far below that. Canada was up 0.8%. Brazil was down 0.78%. Mexico up 1.07%. Earlier today, the Western Europe's markets, Germany was up 0.76%, UK up 0.3%, France was up 0.63%, Eurostoxx the same, up 0.63%, Netherlands up 0.4%, Spain was up 1.42%, Italy up 0.7%, Switzerland up 0.32%, and Portugal up 0.88%. Both Russian exchanges in the red, barely. The MOEX down 0.1%, the RTSI down 0.12%. And the overnights in Asia looked pretty good. In Japan, the Nikkei was up 0.56, Australia up 0.23, New Zealand up 0.61. The Chinese markets all green. The Shanghai up 0.76, SCSE component up 0.56, China A50 up 0.37, DJ Shanghai up 0.74, the Hang Seng up 1.82, and the Taiwan weighted barely up 0.04%. So all in all, not a terrible day, but let's go ahead and look and see how the markets did for the week. The S&P 500 looks like it's going to finish the week off down 0.73. The Dow is going to finish the week off, and granted it was a short week with MLK Day on Monday. The Dow is going to be down 2.49. NASDAQ is going to finish the week off. Where's that line at? There it is. It's going to finish the week off in the green by 0.53%, so up by 0.5%. Dow Dow Utilities is going to finish the week off down 2.84. And the Dow Transports is going to finish the week off down, basically flat, down 0.05%. So it looks like the worst of it was the Dow and the Dow and then the S&P 500 for the week. So let's take a look at the long-term trend and see where we stand right now. This is where this trend line begins at I think it was January 3rd or 4th of last year. We've been in this long-term downtrend. Every time we bump up against this line of resistance, we seem to lose a lot of steam. And we've done that on back here in, when was this? March of last year. Same thing in August of last year. Again in November of last year, and then again, it looks like it's run out of steam here in the last week. So, my guess would be that we'll probably have more of a downtrend over the next couple of weeks, just based upon the way things have been lining up historically. Again, if we break through this line of resistance and have a nice upswing, I think the only thing that could really cause that would be if the Fed stopped raising interest rates altogether and said that they were going to start doing QE and lowering rates again. A lot of the people I listen to seem to think that we're going to bottom out sometime mid-year, and then we'll have another. The Fed will do more things and inflate the bubble again. We'll have a nice run up. Some people I was listening to were saying they think the Dow could get up over 40,000. That'd be a nice little run. I'm not going to argue with it, but then they think it's going to collapse all over again. So at some point, the Federal Reserve, they can only play this game so many times where they buy up toxic assets and inflate the economy and the monetary system. Eventually, it's all going to fall apart. And, the other, people around the world who use the dollar, it's pretty much the reserve currency around the world. At some point, they're going to say, well, I don't want to use the dollar. I want to use gold or oil or the yen or, whatever was it the renminbi in China? At some point, granted, we have the military, which, is what primarily keeps the dollar in charge. But at some point, people are going to say, you know what? I'm tired of losing money holding wealth in dollars. I'm going to move it to something else that doesn't get devalued every time that the U.S. hits a bit of a road or a bump in the road. So, all right. Well, let's go ahead and breeze through today's economic data. Initial jobless claims came in at 190,000. Forecast was 214, so that's pretty good. I think we talked about that yesterday. Continuing claims came in at 1.647 million. Forecast was 1.66 million. Last week's number was 1.63 million, so it went up a little bit. But again, it's in line with historical trends. I'm not really too worked up about how that looks. The producer price index came out on Wednesday. Year over year, we were up 6.2% on producer prices. Personally, I think this is a better gauge of inflation than the CPI. But people will argue about what is best or what's worse or however. And we can see, from the peak we had here back in April and again in July of last year, it has pulled back quite a bit. Down to that 6.2 number. Month over month, we actually had a contraction in producer prices by 0.5%. So that is certainly some positive news, to see that. I mean, for, basically several years, we had, add, 1%, 0.7, 0.5, just every month things were getting more and more expensive. U.S. retail sales year over year grew at 6.02%. Last month's number was a 6.01. So we did bump up a little bit from last month's numbers, but it has contracted a little bit over the last couple of months. The month over month number, we actually contracted on retail sales by 1.1% on the month over month number. So again, looking at the month over month, the producer price index shrank. Again, that's some good news. Retail sales, though, is down month to month by 1.1%. So again, a slowdown in retail sales. Industrial production grew at 1.65%. Last month's number was at 2.18. So again, we are seeing a slowdown in manufacturing and production. The month over month number, we contracted by 0.7%. So again, and for the last few months, we've had contractions going back to, let's see here. Going back to July, we've had contractions in 1, 2, 3, 4, 5 out of 7 months. So, things again, I know if you listen to the administration, they say, oh, everything's fine. It's great. But I mean, you can just look around. Things aren't terrific. They're not bad, but there certainly could be a lot better. Housing starts grew at 1.382 million. Forecast was 1.359 million. Last month's number was 1.401 million. So housing starts have slowed down a little bit. The month-over-month number contracted by 1.47%. And we've been seeing contractions in the housing starts pretty much most of last year. I mean, there was 1 month, September, where it grew by 12%, but most of the months we've been in a contraction phase. And that makes sense with, the Fed started raising rates in, February or March of last year. And, since then we've had a, protracted series of months. Like I said, other than September's number, everything else looked, has been shrinking. And again, that has to do with interest rates going up. It's just going to happen. Existing home sales, 4.02 million was the number that came out. The forecast was 3.96. Last month's number was 4.08 million. So contracted by about 60,000 units in the last month. And I think this is probably the month-over-month number. We actually contracted by 1.5% in existing home sales. The forecast was negative 5.4%. So we beat that number, but still, again, looking back to when interest rates started to climb, we've had just reduction of 7, 2, 2.5, 3.5, 5.5, almost 6, 0.5%, 1.5, almost 6. 7, about 7.5, almost 8% last month and 1.5% this month. So again, not really surprising based on everything that's going on with rates and with the price of homes that has gone up dramatically over the last year. So, or last 2 to 3 years, really, because a lot of people's when a lot of the blue cities were making everyone wear their gag masks and all these ridiculous rules for, the super sniffles. A lot of people said, what, screw it. I'm moving out to the country. And I mean, that's where I live. My little part of the world I have not had to do a whole lot of all that nonsense. Really, the only time I have to, pretend that my little cloth rag does anything is when I go and get my infusions at my rheumatologist. And that's once every 2 months. So, and I complain and bitch about it every single time because I have to be a pain in the ass. All right, well, let's go ahead and read through today's market recap, see what they had to say. SP 500 rides Netflix Alphabet rally higher. The SP 500 gained Friday as technology hitched a ride higher on a surge in Alphabet and Netflix after the latter's quarterly results showed a rebound in subscriber growth. Netflix's lower than expected quarterly earnings were offset by subscriber additions of 7.5 million that far exceeded expectations of 4.5 million. The trend of subscriber growth is likely continued, led by streaming giant's new advertising tier. Quote, the important takeaway is that the new ad-supported tier resulted in retention of subscribers, end quote, Wedbush said in a note following Netflix's results. Quote, we expect this phenomenon to repeat itself in the coming year with the result that we expect Netflix to return to subscriber growth of 17 million new users per year, end quote. Alphabet also racked up gains to help tech advance as investors cheered news the tech giant would cut costs by axing about 12,000 jobs. The move in tech stocks has the runway to continue, some say, as investors are expected to continue rotating away from defensive positions. Quote, the short-term development suggests investors are rotating away from the defensives and that risk-on bias can continue to return even as we move through earnings season and the threat of recession weighs on investors, end quote, Janie Montgomery Scott said. Financials were also in the ascendancy, powered by a 16% rise in SVB Financial Group, as Wells Fargo talked up the Silicon Valley Bank, saying it, quote, remains the trusted partner in the innovation economy, end quote. Ally Financial, meanwhile, reported quarterly results that beat both the top and bottom lines, sending its shares 19% higher. Elsewhere on the earnings front, PPG Industries reported inline earnings and revenue that topped estimates as the paint and coatings maker benefited from price hikes. Treasury yields, meanwhile, continued to rise even as Fed Federal Reserve officials continue to support further slowing rate hikes ahead of a meeting next month. I think it's probably the first week of February. In other news, the Federal Reserve is reportedly probing Goldman Sachs' consumer business, Marcus, amid concerns the bank may have failed to implement proper monitoring and safety frameworks to protect customers. Ooh, that might be some bad news in the future for Goldman Sachs. So we'll see what happens there. All right, and I got one article here, just some food for thought, why the Fed is bankrupt and why that means more inflation. So this is written by Ryan McMacken. This comes from Mises Wire at Mises.org. And well, let's see what he has to say. In 2011, the Federal Reserve invented new accounting methods for itself so that it could never legally go bankrupt. As explained by Robert Murphy, the Federal Reserve redefined its losses so as to ensure its balance sheet never shows insolvency, as Bank of America's Priya Misra put it at the time. As a result, any future losses the Fed may incur will not show up as a negative liability, negative interest due to Treasury, as opposed to a reduction in Fed capital, thereby making negative capital situation technically impossible. That was 12 years ago, and it was all academic at the time. But in 2023, the Fed really is insolvent, although its fake post-2011 account doesn't show this. Nevertheless, the reality is that the Fed's assets are losing value at the same time the Fed is paying out more in interest than it's making in interest income. This became clear last week when the Fed released a new report showing that its interest payments on bank reserves skyrocketed in 2022. The press release states total interest expense of $102.4 billion increased $96.6 billion from 2021 total interest expense of $5.7 billion. Of the increase in the interest expense, $55.1 billion pertained to interest expense on Federal Reserve balances held by depository institutions, and $41.5 billion related to interest on securities sold under agreements to repurchase. As this graphic shows, as this graphic from the Fed shows, the cost of operations also exceeded earnings in 2022 because remittances have fallen from 2021. And you can see that here on this chart. For the year overall, the Fed still managed to achieve a positive net income thanks to positive inflows in the first half of the year. But since September, as Reuters noted, the Fed began recording what's called a deferred asset, which tallies up the Fed's loss. The deferred assets stood at $18.8 billion at the end of the year. The deferred assets phase would basically mean losing money in Fed speak. The Fed is supposed to make remittances to the U.S. Treasury out of its surpluses, but when it has no surplus, the Fed defers its payments. We can see how these remittances plummeted into negative territory beginning in September, and that's what this chart shows. The trend of falling remittances is unlikely to reverse in 2023 unless the Fed takes a very dovish turn and forces interest rates down again. What is more likely is that the Fed will hold rates flat and only slightly reduce them. In either case, the Fed will have to keep paying out more interest than it makes in income. A sizable part of the reason the Fed has become insolvent in recent months, and almost certainly will be in 2023 overall, stems from the fact that since 2008, the Fed has bought up trillions of dollars of Treasury debt and mortgage-backed securities. The Fed has done this to prop up the prices of real estate and government bonds, i.e. subsidize Wall Street, banks, and the real estate industry. Yet it bought these fixed rate assets when interest rates were very low, and most of the assets have a maturity over a year. That means that even as interest rates have risen in the past year, the Fed's income from these assets has not risen sizably. Yet the Fed is also paying banks interest on reserves and reverse repos. That interest rate is not fixed and changes rapidly. So although total reserves at the Fed have fallen by 25% in recent months, that won't bring interest payments down to 2021 levels because interest rates have increased 4,300% from 0.1% to 4.4%. The end result, the Fed is now paying out more interest to banks that earns in income from mortgage-backed securities and government bonds that it holds in its portfolio. Thus, as we saw in the Fed's Friday release, outflows and interest payments have surged, but income has not, and the Fed is now forced to defer its promised payments to the Treasury. Another complicating factor driving the Fed deeper into the red is the fact that that its portfolio is also losing value. The key to understanding how this becomes a problem is to remember that bond prices move in the opposite direction of interest rates. So as newly issued bonds interest rates, i.e. yields, move up, the price of the existing bonds moves down. As interest rates move up in the past year, the value of the Fed's mortgage-backed securities and Treasury debt has fallen. So now the Fed has less capital. Thanks to Enron-like accounting, however, the Fed's bankruptcy is legally just a matter of deferred assets. So it's not a legal problem for the Fed. Nonetheless, the Fed's losses are likely to mount further and require a bailout. Can be seen in the fact that we've seen this sort of problem before. As noted by Alex Pollock in a 2022 lecture at the Mises Institute, the Fed has put itself in a similar situation to the one that sank the savings and loans in the early 1990s. And the S&Ls, like the S&Ls, the Fed invested in large amounts of long-term debt at a low fixed interest rate, but then interest rates went up. The fixed rate interest income stayed largely the same, but interest payment obligations increased sizably. That's where the Fed is at now. For a normal financial institution, this situation leads to bankruptcy, but the Fed will bail itself out by printing money. In the end, that means price inflation, either in assets like stocks and real estate or in consumer goods like eggs and auto parts. Or ordinary people will see their costs of living go up and their real wages fall, and they'll get poorer. Through it all, though, the Fed and the regime will itself will benefit. As the Fed has been careful to say in recent days, its de facto bankruptcy does not impede its ability to carry out its usual inflationary monetary policy. Never fear, because the Fed can create its own its own income. It will at will via monetary inflation. The regime will continue to benefit from the Fed's usual tricks. The regime will be able to run higher deficits, spend on free benefits for voters, and on corporate welfare for the politically powerful. It's all a great scam for the parasitical class. For the productive classes, not so much. All right, I realize that was a bit long, but something I wanted to go through. So, based on Mr. McMackin's guesstimate, in order to bail out the Fed from their insolvency, they're going to have to create more inflation, which is what we're going to see probably somewhere down the road. So, there is a simple way to stop this. Stop using dollars. Use gold, Bitcoin, whatever, something not tied to the dollar, and you probably would have more stability in the value of your assets and your income. But unfortunately, that's not going to happen anytime soon, because people in charge like robbing, the little people like you and me. So, all right. Well, that's everything I had for today. If anyone needs anything from me, please go to dsafinancialgroup.com. All my contact information there. You can book a meeting, drop me a phone call or an email, or send me some ideas on something to talk about. I'm always open to that. So, hope everybody has a wonderful weekend, and I will talk to you guys next time. Adios.